I think we should start our class without further delay so that we can cover adequately before we get tired. So I need anyone to confirm that you can hear me so I can proceed with the class.
Morning, sir.
Good morning, sir.
Good morning. So how are you guys doing? And I hope you are preparing for your exams. Now the exams are very close and you are at the critical point of the exam. Whatever you do now would actually count for you. And this is the time you have to make every sacrifice that needs to be made. The exam is just around 5 weeks away. Make any sacrifice that's required to ensure that you don't fail the exam. So, for us, our normal class, we're going to do whatever it is we have to do to round up every nook and cranny of the syllabus for us and finish up. And also for the XBR, after we are done with everything we need to do, I would be doing a 2 days revision class for for you guys. It's more like also like an intensive where we are going to revise the key topics that we know always comes out every diet and also solve past questions to be a 2 days intensive class. And the same thing for the FL student as well. But primarily, we need to actually cover up, and you also need to have read before before that time comes. So technically, we have like two, maximum 3 weeks, maximum three for us to finish up all the little things here and there. And part of the little things here and there is this aspect of the syllabus associates, which we looked at in depthly last week. And we stopped at the point of the question that I asked you to go and practice, which some of you actually attempted because you shared it with me. So as promised, I will solve that very quickly in class today first. But let me remind you that when it comes to investment in associates, there is usually an investor that has put down so much money and has acquired the equity interest in another entity, and its holding is now between 20% but less than 50%. And when an entity has investment in an associate, IS 28 requires that you would need to consolidate the associate. But in consolidating the associate, it uses what we call an equity method. And equity method simply requires that the investor would incorporate that investment in his books at its carrying amount at the end of every year. And that carrying amount would be the cost of the investment. It will add a share of its post-acquisition profit of the associates. If he receives dividend from the associate, he removes it because this is intra-group transactions. So this dividend received can only show in his own separate account, not in a group account. We cancel out similar transactions like this. And if there is an impairment of that investment, it would also remove it. So basically, this is what the investor would show in the consolidated account. And we wouldn't shy away or forget the fact that the investor is also an entity, a legal entity on his own that also prepares his own financials. And in his own separate financial statement, he would present that investment at cost or in line with IFRS 9. So it's going to be seated there at cost in his own book. So this is the only item that will show in his own separate account. But in the consolidated account, that is when he applies the equity method by increasing that investment with share of profit. And I told you that in a consolidated account, since the investor is going to be increasing the investment with his share of profit, it's possible that the associates start making losses. And when losses become cumulative, it might convert these investments to zero or even negative. Is it possible for this investment to become zero or negative? Oh, yes. If there are losses for several years, you can convert it to negative. So in that case, if you are exposed to such an associate, as soon as this investment is decreased to zero, then you have to cease from incorporating that investment in the consolidated account because we cannot have a negative asset. And since it's not like there is an obligation, if it doesn't have any obligation to settle anybody, so we cannot equally put it as a liability. So when associate is making losses and this becomes like a deduction, you have to stop incorporating that investment in a consolidated account when this investment becomes zero. And when you transact business with the associate, you have to cancel out such transactions in such a way that any profit that you make from such transactions should be eliminated. We do not incorporate such in the consolidated account. If it is a transaction where it is the parent that is making the profit, yes, you can deduct the profit from the retained earnings of the parent. But since the inventory is with the subsidiaries, is with the associate, I mean, and we do not consolidate the inventory of the associates in the consolidated account. The only item where we can deduct the unrealized profit from, therefore, is the investment in associate. So we deduct it from the investment in associate. And don't forget, the unrealized profit that we are going to be eliminating is to the extent of our holding in the associate. But if it is the associate that is selling to the parent, yes, we will deduct the retained earnings from the associate. We will deduct the unrealized profit from the associate retained earnings, and we can equally deduct the unrealized profit from the inventory of the parent. We can easily have access to the inventory of the parent now because, I mean, this is the parent. He's the one preparing consolidated account, and he can easily deduct whatever profit that is incorporated in the inventory acquired from the associate. He can remove such unrealized profit from it. And we actually discussed this at length last week. And we started solving examples until we got to the last one that we said, okay, you guys should try it yourself. Now let's solve it now. If you remember, we read this question, and this question is talking about the statement of financial position of PICO and his investee companies, ESCO and JECO, as at 34 December 2017. So we're given the statement of financial position of these three entities. They gave us some additional information. They told that PICO acquired 1.2 million shares in ESCO in January 2010 for 2 million when retained earnings were 400. And at that date of acquisition, the fair value of its freehold property was considered to be 800,000 greater than its value in ESCO statement of financial position. The building element comprises 50% of the total value at the remaining life of 50 years. Also told that PICO acquired 450,000 shares in JECO for January 2016 for 1 million, when the retained earnings of JECO were 300,000. We also told that ESCO manufactures a component used by both JECO and PICO, and ESCO sells this component at cost plus 25%. PICO held 200,000 inventory of this component as at the end of the year, and in the same period, PICO sold goods to JECO, of which JECO had 160,000 in inventory at 34 December 2017. PICO had marked these goods up by 25%. We're also told that the goodwill in ESCO is impaired and should be fully written off. An impairment loss of 104,000 is to be recognized on the investment in JECO. So told that non-controlling interest is valued at full fair value. And ESCO's shares were trading at 160 kobo just prior to the acquisition by Pico. We are required to prepare a consolidated estimate of financial position. Now, since we are required to prepare a consolidated estimate of financial position, and we need to establish what we are dealing with, because the investor, Pico, has more than one investee company, we need to establish its relationship between the two entities. And the additional information will help us with this. Firstly, we're told that Pico acquired 1.2 million in ESCO for 2 million when the retained earnings of ESCO was 400,000. Apparently, this is the purchase consideration and this is the pre-acquisition reserve. Let's see the relationship between Pico and ESCO. So, from our workings, Pico acquired how many percent holding? I can compute it. That's 1.2 thousand shares divided by how many shares does ESCO has? This is ESCO's account. We have 2 million shares divided by 1 naira because this is 1 naira nominal value. If the nominal value had been 0.5, then we'll be looking at 2 million divided by 0.5. But this is 1 naira. So the total number of ordinary shares in ESCO is 2 million. So 1.2 divided by 2 million,
60%.
that gives us 60%. So Pico acquired 60% equity interest in ESCO. Therefore, Pico is a parent to ESCO, and ESCO therefore is a subsidiary. So this means that NCI is 40%. And they give us purchase consideration and pre-acquisition reserve. And that would help us with our elimination. I can see that this 2 million is already incorporated here. It's here already. If it wasn't there, that means you need to incorporate it yourself by passing some journals. We're told that at the date of acquisition, which is 4 January 2010, the fair value of its premises was considered to be 800,000 greater than its value in ESCO statement of financial position. So they are telling us that when Pico acquired ESCO, they discovered that the freehold property of ESCO is actually 800,000 greater than its book value. So there is a fair value surplus. And how do we adjust for this fair value surplus? So note 2, there is a fair value surplus of 800,000. Like I told you, you're going to add to pre-acquisition reserves. You're going to treat it as a pre-acquisition reserves because it was determined at the date of acquisition. So it's a reserve, like a crediting reserve. And you're also going to add to the freehold property. You're going to add it to the freehold property of ESCO because it wasn't incorporated before. We just discovered it. So these are the two legs. So we're going to add 800K and 800,000 for the two. Additionally, because the year-end year is 31st December 2017, and this asset that we are incorporating into our books newly is being incorporated at the date of acquisition. We are just incorporating it. And this is 2017. That means that this 800,000 that should have been incorporated in the book since 2010 was not. It wasn't until now that we are discovering it, that we are preparing consolidated accounts, that we discover that, there was an 800,000 XX that when we acquired this guy, the fair value of its assets was over and above its book value by 800, and it has not been included. For good, that's 2010, 11, 12, 13, 14, 15, 16, 17, 8 years. The implication of that is that they have not charged depreciation on this amount for 8 years. However, considering the fact that this is a freehold property, which means that it will include land and building, and you all know that land is not a depreciable asset because land has an unlimited useful life. It's only the building element that is depreciated. And that was why the examiner told us that the building element is just 50% of the total value and its own useful life is 50 years. On that basis, we need to calculate additional depreciation only on the building element. And that would be 50% times the 800,000, which gives me 400,000. This is the building element portion. And having determined that, we can then determine the additional depreciation, which is 400,000 divided by the useful life of the assets, which is 50 years. 400,000 divided by the useful life of the assets. Sorry, just need to put them together. Okay, which is 50 years. And we have not charged depreciation for good 8 years. Following from this, what is the additional depreciation that we need to charge?
64,000.
64,000. You see, this additional depreciation, what do you do with it? You are going to then deduct it from the retained earnings of ESCO, and also you are going to deduct it from the cost of the freehold property of PP. And that's it for that particular, and that's it for all this. Additionally, I was told that PICO acquired 450,000 ordinary shares in ESCO on 4 January 2016 when the retained earnings of JCO, what the retained earnings of JCO was 300,000. Okay, Ifeoma, I can see your hand. Can you ask your question quickly?
Sorry, it's a mistake, sir.
Okay, good. So now we can establish the relationship between PICO and JCO. What's the relationship? Note 3. PICO acquired how many percent holding in JCO? How many percent holding in JCO? He acquired 450,000 shares in JCO. And how many shares does JCO has? JCO has 1,500 shares, which is 1.5 million divided by 1 era. 1,500 shares. And we acquired 450 out of that 1,500. So how many percent holding in that?
30%.
Okay.
30.
So he acquired 30% equity interest in JCO. So JCO is his associate. Now, having established that they are associates, I was given the cost of investments and also the pre-acquisition retained earnings. That's noted. Now I'm told that ESCO, whom we have established that is our subsidiary, manufacture the component used by JCO and PICO. ESCO sells this component at cost plus 25%. They don't need to tell you that this 25% is markup. So he sells it at cost plus markup. And PICO held 200,000 of these components as at the end of the year. So PICO has 200,000 of the inventory he acquired from ESCO in his books, meaning that there is a profit element in this 200,000 that we need to eliminate. It has to be removed. In the same period, PICO sold goods to JCO, and JCO had 160,000 in inventory at 31st December 2017, and PICO had marked up this good by 25%. Again, there was a transaction between the parent and his associate, and this associate has 160,000 of these goods in inventory, which means that this 160,000 in the inventory of JCO is being carried at a profit loading that we need to calculate and remove. So let's remove this unrealized profit. Let's remove this unrealized profit. So we want to deal with intragroup trading. First, transactions between ESCO and PICO. Here, my attention is majorly focused on the unrealized profit. Okay, I can see a series of hands up. I mean, if it's urgent, let me listen to you, please. Okay, let me start with Charity. Is this still a mistake or you want to ask a question?
Sir, I want to ask a question. Oh.
Okay, go
Good
ahead,
morning,
please.
sir.
Hi, how
So,
are you?
fine, sir. The additional information 3, where Pico acquired 30% of JCO, which is an associate. I
Yes.
noticed that we did not really specify the NCI.
You are the
So,
NCI. You are indeed the NCI. So they cannot be NCI. You are an associate.
okay.
You are the NCI. So they can't be NCI. It's when you have control that you can be talking about NCI.
All right, sir.
Yes.
Thank you.
You're welcome. Okay. Next, what's the next question? Umi?
Yeah, good morning, sir. I wanted you to take the number D again, the explanation around that. Yeah,
Okay.
it
Okay.
wasn't clear. Thank you.
No problem. I'll do that. Okay. I think I can do that with this solution. So based on D, you can see that there was a transaction between Pico or between ESCO and Pico. And whenever ESCO sells component, it sells component as cost plus 25%. And they need not tell you that this 25% is markup because they say cost plus markup is related to costs. So any profit you add on cost is called markup. And when ESCO sold to Pico, Pico had 200,000 of this inventory in his books. That means this 200,000 in this inventory, there's a profit load there. That profit loading should be eliminated. We have to eliminate that profit, and which is an unrealized profit. And how do we do that? We have an inventory of 200,000 that has a profit loading. we want to remove it. How much is the profit? We know that they have included a profit of 25%. See, if you do 25 over 100 and apply on 200,000, you are wrong. Because this 200,000 is not at 100. It is at 20, it at 100 plus 25%. So it is actually at 25. It's actually at 125. So to determine the unrealized profit inside this 200, it will be 25 over 125. And if you punch your calculator, what would that give you, please?
40,000.
40,000.
40,000. Now, this 40,000 unrealized profits that was made by ESCO, how do we eliminate it? To eliminate this, you are going to deduct the unrealized profit. I hope you remember. Let me write it in first. Some of me, I don't remember. We're going to deduct the unrealized profits from retained earnings of ESCO. Being the one making the profit, you deduct it from it. And also, you're going to deduct the unrealized profits from the inventory of whom? Of PICO, because the inventory is the twin. So with this now, we will have removed the unrealized profit from our books. And secondly, is the transaction between PICO and JACO. Again, my focus here is for me to eliminate the unrealized profit. And how do I eliminate this unrealized profit? I saw that it was PICO that sold to JACO, and JACO has 160,000 of this good in inventory. And this 160,000 JACO has in inventory includes profit loading that has to be eliminated. And the profit loading inside is 25%. So this 160 is not at 100%, but at 125%. To establish what the profit load is, we're going to do 25 all upon 125. If you do this, what would you get?
32,000.
82,000.
You get 32,000. However, the unrealized profit will be to the extent of our holding in the associate. You can only eliminate unrealized profit to the extent of our holding in what? In the associate. So the unrealized profit you can eliminate is just 30%. And what does that give us?
$960.
9,600.
9,600. Now let's eliminate this unrealized profit. To eliminate it, who is making the profit? Is the parent. So it's the parent that sold. So we can deduct the unrealized profit from the retained earnings of the parent of PICO. And ordinarily, we should also deduct from the inventory of JACO, but we do not consolidate the inventory of JACO. The only item that is representing JACO in the consolidated account is the investment in associate, is the investment in JACO. For that reason, we're going to deduct the unrealized profits from the investments in associates. We're going to deduct the unrealized profits of 9,600 from the investment in associates. And that's it for that.
Sorry, sir. I want to ask a question.
Please ask.
In a situation whereby there is there's transactions between the subsidiary and the parents. Maybe in case of sales of goods like this, but a percentage is not given. You know, for this one now we are giving like 25% of goods that are not being sold. You know, how do you now calculate the unrealized profit? Whereby, okay, for instance, maybe 50,000 goods was sold to a subsidiary, and out of that 50,000 goods that was sold, it still remaining like 30,000 goods from the books. So, but percentage is not given. So how do you calculate the unrealized profit? Whereby you're not giving a percentage in the question. I don't know if you get my question, sir.
Yes, of course. They will always give you the element of profit because the focus is remove the profit. So they can't just tell you that this is the goods in inventory without telling you the profit load. They will definitely tell you. Is either they tell you the absolute figure of the costs, that this is what it cost him and this is how much he sold, then you can easily get the profit load. Otherwise, they will always give you the profit loading. So there's no way they can give you a question without giving you a clue on how to determine the profit, because that's really what you want to eliminate. So they would always do that for you. Or they give you the absolute figure of the profits, then you then go ahead and do your elimination directly. Did I answer your question?
Okay, sir. Maybe I will send one question to you later, sir. Yes, sir.
Okay. So I would appreciate you share it to the group so that others also would also be able to contribute and benefit. All right. So for the next one, they said goodwill in ESCO is impaired and should be fully written off. Impairment loss of 184,000 is recognized in investment in JAKE. Okay, this is talking about impairment. And finally, NCI is valued at fair value. ESCO's shares were trading at 160 kobo prior to acquisition. Okay, so I think we can start eliminating now. We're done with the workings. Okay, please go ahead with your question. I can see your hands.
Sir, please, on that question on inter group transfer, that's this thing is markup, not I thought it's margin we are using in that place.
No, it's not margin, it's markup. So, which is why it's still 25 or 125. I mean, what do you think it should be?
Read the question for it said it's mark. Does that mean
Eh,
mark?
yes, it's markup. And
Okay.
it's clear, right? So if they tell you that it's cost plus 25%, that's markup. It can never be margin, it's markup. So this is markup, cost plus 25%. So and they say this one is marked, this goes by 25%. They have also marked it up as well. So this is also a markup as well. And see, I've just find a way to make you understanding and not cram it, because really this 25 over 125 you are seeing us doing is converting this 25% markup to margin. That's what we're doing. But if I say that, yes, if I say that, okay, I'm converting to markup to margin, right? The explanation is that because this is selling price and you can only apply margin on selling price, then that would be my explanation. But a better way to look at these things is this. You find that in most of your questions in recent times will give you that they marked it up. It's always because that's how it is in practice. That's how it is in real life. People mark up costs. Nobody walk back from margin. No. Margin is like a walk back. It's a complex approach. So the direct thing is that you get your costs, then you mark it up. And that is what you find in most questions. So better way to understand this is that This is at 125% in this case because they have marked it up. Is a 125% value. So to get the profit load is 25 over 125 times this. That's the profit because this is at 125%. They have marked it up already. The same thing applies to this. Okay. Another way the examiner can test this is to directly, instead of giving you this, is to say they have a margin of this. If they give you a margin, then that means they have already given you a profit that was determined based on this selling price, then which you can apply directly. You don't need to, if they give you a margin of 20%, for example, to get profit is just 20% directly on this 200. If they give you a margin of 30%, just apply 30% directly on this selling price. Okay. But you find most questions in recent times, it's always structured this way because that's how it is in real life. People mark up their cost, not working back and getting a margin. They mark up their cost. So you need to then know that if this has been marked up, that means these figures are at a profit loading. Then for you to get a profit out of it, you need to take the base also to 125 or to the extent of that profit load to ensure that you are actually determining the right profit. So that's how I really need you to understand it so that at any point in time, you would not misinterpret and make errors. Now, let's determine the goodwill. Let's cancel out. Let's start cancellation. So I can see that when I acquired this subsidiary, I paid 2 million, which of course is included in this 3 million. When I acquired this associate, I paid 1 million. That's why we have investment of 3 million here. So 2 million here will need to be cancelled out against the equity of the subsidiary, which usually gives us goodwill. So I start with consideration transferred, which is 2 million. And again, in order to make it 100% against 100%, we usually include NCI. Now I'm being told that NCI is measured at fair value. So I will do 40% of the number of shares in ESCO. ESCO has 2 million shares. So 40% times 2 million shares will give me the number of shares ESCO or SCI has in ESCO. And I was given that at the date of acquisition, the share price of the subsidiary was 1.60 kobo. If I multiply that by 1.60 kobo, can you give me your answer? What will it give us?
1,280,000.
1,208. Like this, Abi?
No, 280.
280. Okay. So the addition of these two, we should be looking at 3,280. That will be then the cancel out against the net asset that we acquired of the subsidiary, which comprises of the share capital of the subsidiary. And the share capital of the subsidiary is 2 million.
1,000,000.
And the pre-acquisition reserve
400,000.
was given in the question as 400,000. Pre-acquisition reserve was 400. And don't let us forget this 800. This 800 fair value adjustments that we said we are going to treat as a pre-acquisition reserve. So there is a fair value surplus of 800,000. So if I sum these three together, I should be looking at how much?
3,2.
3,200. What's the difference between the two?
80,000.
That's 80,000. And I was told that this goodwill in note 5 has been fully written off. So there's an impairment of goodwill. Impairment of goodwill that we need to deduct from here. So that means our goodwill is therefore nil. And don't forget that this impairment of goodwill that we deducted, we are going to, so in addition to deducting the impairment of goodwill from the goodwill, we should also deduct it from the retained earnings of the subsidiary. And the reason is that this is because you know that ordinarily I should remove this impairment from the goodwill of the parent because goodwill belongs to the parent. But yeah, I'm saying that I should deduct this impairment of goodwill from the retained earnings of the subsidiary. Because, who can tell me why? This is because of what?
Event of measured at fair value.
Thank you very much. This is because the NCI is measured at fair value. That means NCI also should have a share of the goodwill. NCI will have a share of the goodwill. Any question?
Sir, does this mean that our restated goodwill is 0?
Yes.
Oh, wow.
So please, I have a question.
Okay.
When I solved this question, what I did was the impairment, I gave the parents a percentage and I also gave the NCI a percentage. I didn't take it to the retained earnings of the subsidiary. Can it be done that way as well?
Well, yeah, of course, you are correct, but with the way I do mine, that's a longer approach.
Okay.
When you know that from the way I structure my consolidated retained earnings, if I deduct it from retained earnings of the subsidiary, meaning that whatever is remaining in the retained earnings of the subsidiary is what the parent and NCI will share, less that impairment already. So with what you're doing, you are going to share the retained earnings of the subsidiary. You are now sharing this one again. I mean, it's a longer process.
Okay, sir.
I'm not sure whether you're seeing what I'm talking about, but it's okay.
Yes, yes.
All right, so I think that's all for goodwill. Then I can determine my consolidated retained earnings. Which is that of Pico, Esco, and Jeco. And given the level of rounding off to be in thousands, and as per my question, or at the date of consolidation, either one, I was given the retained earnings of the three of them. So let me pick it up from the question. And I can remove the pre-acquisition retained earnings. I can remember that of this guy should be 400. And this other guy
300.
is 300. Okay. Now, then I can get their costs. So what's the post of this guy? This will be 1370, if I'm correct. And this should be 480. Now, having determined that, I need to remember the adjustments that I've made so far. And the very first is, I said I'm going to deduct 64,000 from the retained earnings of ESCO for additional depreciation. So let me quickly do that. So additional depreciation. Sorry, I'm always forgetting your name, Tintin, because that's what you wrote. So with the way you say you did impairment, that means you will have done this depreciation like that too. You give a portion to NCI, give a portion to parent.
No, sir. That one I gave it straight to ESCO.
So what you should give the impairment straight to ESCO as well.
All right, sir. Thank you, sir.
Yeah. So this is 64. Let me just put them together. Like spacing is okay. After the additional depreciation, the next one was the intragroup trading. And we said we're going to deduct this 40,000 from the retained earnings of ESCO as unrealized profit. So unrealized profits. Deduct 40 from retained earnings of ESCO. Additionally, we also said we are going to deduct unrealized profit from the retained earnings of Pico, since it was the one that sold, of 9,600. So 9.6 from retained earnings of Pico. Also, there was an impairment of goodwill, which we said we are going to remove from retained earnings of the subsidiary of 80. So impairment of goodwill. So that would be 80. There's something I'm omitting, and that's why I was supposed to have done investment in associate before this, because I was told that associate investment was also impaired. Oh, they even told me 184. That's fine. They gave me 184 directly. Oh, impairment of goodwill, 80. Now, impairment of associates investments of 184. Payment of associate investment of 184. So what again? That's all. So let's get the totals for these guys. Total, yeah. So how much are we looking at?
So I thought we would take the proportion of the impairment in associates.
Take the proportion of the impairment in associates. You know that this investment in associates already is our own investment, is our own money in the associate, the money we have invested in the associate. Now, it's like you invested 1 million. 184 was now impaired. So there's no need taking a proportion. Is your investment that was is your investment that was impaired. So from investment account, you remove everything. But here also, you're going to remove everything. But when we are taking our share of his profits, we only take a share of it. But at this level, you are deducting all the loss from JCO's earnings. By the time you are getting a share of the resulting profit, then you'll see. Let me read. But give me this first. What's the total here? I mean, there's nobody pressing calculator. Everybody is waiting for another person to press. Somebody should take response. Is Michael not here? Michael was used to be the responsible person.
2,556 naira for ESCO.
2,556. Okay. 2,000K.
Oh, no, so sorry,
Yeah,
sir.
they
I
don't.
added the other one.
Sir, ESCO is 1,186.
186.
Okay, thank you.
86, yeah.
What about this?
296.
296. Okay, so let's now take the group share. In ESCO, we only have 60% of its share of profits. In JECO, we only have 40%. Sabi? Is it 40 or 30?
30.
We have 30%. So what's 60% of 1186?
711.6.
711.6. That's 712.
How about this?
89.
89.
What's the total? 2920.
801. Okay.
801.
2920 minus 9.6 plus 712 plus 89. So that means that 801 you got minus this, add this.
3,711.4.
That 0.4 is a problem. Maybe we should not approximate this 7.1 whatever. It will have cancelled that one another. So I think this was 711.6 or so. Can you give me
Yes,
this
sir.
again?
711.6.
Mm-hmm.
88.8. The second one.
So the final answer we can be approximated. So 2920 minus 9.6 plus 711.6 plus 88.8.
3711 approximation.
Okay, if you don't approximate, it gives you what?
3710.8.
Yeah.
Okay, let me just leave it first. Then 7 is non-controlling interest. And the value of NCI from our calculation above, here's the value of NCI, is 1,280. And share of ESCO's tenants, which is 40% times 296. What does it give us? No, 296 cost, sorry. 1186.
474.4.
474.4. Okay, so what's the addition of all this?
1,754.4.
Okay. Number 8 is investment in associates. Cost is the cost of investment.
1 million.
Then share of post-acquisition retained earnings. JCO post-retained earnings. Which is 30% times 480. Okay. Does that give us?
144.
And there was impairment loss of how much? Of 184. So how much are we looking at?
$960.
960. And that would be our investment in associates. So we have PICO. We have consolidated statements.
What about the unrealized profit in investment in associate?
Did you deduct it from investment in associates?
There is unrealized profit between
Okay, this one.
JCO. Yes, sir.
Okay, we said we should deduct from investments in associates.
The unrealized profit.
Yeah, I've seen it. I've seen the workings. So thank you, my Femi.
So please, I have a question.
Okay, please ask.
The share of the JCO post retained earnings, you only shared the 480. The impairment, you didn't take into consideration.
Yes.
Okay.
Yes, I did not because it's still coming here.
Okay. All right.
So how much is the balance here?
950.4.
950.4. And you need to understand it very well. We're not just doing what we think we want to do, you see. The double entry for this impairment loss, the journal is you are debiting in these investments, you're debiting your P&L and your credit. In fact, you even made a mistake. I thank God I was talking about that. This impairment is not a loss to JCO. It's a loss to PICO. It's a loss to PICO, not JCO. So, yeah. So this impairment in associates, we are debiting our P&L, which is the parent, because it's a loss of our investment. And we are crediting this investment here as a deduction. So this will not fly here. This should be 480. So can you recalculate this for me, please?
$144.
144. So 2920 minus 9.6 minus 184.
1,002.
You have considered everything?
No, sir, for the share. The 116. The
Oh, okay.
1186 is now
No.
Everything is 3,582.
This one should not change now. It should still be the same thing. 60% of 1186. Mhm.
Yes, you said 116. That one is correct.
So, okay. As at which period? Year ended 31st December 2017. Okay. NCI will also change. No, NCI will not change. Doesn't have a chair of associates. Okay. So, what was the first item here? Period property. Can you hear me add these two?
Seven
6,400.
thousand four hundred.
This
Seven
four.
The
thousand.
6 for the 2 is
6,400.
6 here.
Mhm. 6,400.
Yes, sir.
Okay. 6,400. So we're supposed to add and
Fair
deduct
value
something
surplus.
from here.
Yes, the fair value surplus.
There's a fair value surplus.
800.
200,000.
So we add 800.
Less depreciation.
And how much is the depreciation?
64.
So what do you have now?
7,136.
7,136. So what's the next item?
Machinery.
Non-machinery. We'll add these two together.
2,340.
2,340. What's the next item? Okay, investments. So a portion of it has been cancelled out. That gave us goodwill of 0 because the goodwill was fully impaired. And the remaining 1,000 here need to be consolidated. And we're going to consolidate it as an investment in associates. And the figure is 950.4. So I would have investment in associates. I will have 950.4. So if I add everything together, what does it give us?
10,046.4.
10,046.4.
Then our current assets. I have my inventory. What's the addition of these two?
1,150.
1,750.
And deduct
And we said we're going to deduct inventory of
Unrealized profit.
40. So we have
1,070.
1,750 minus 40,
1,070.
1,710. Then the next item is trade receivables. And those are trade receivables. What's the addition of these two?
1,240.
1,240. And the final item is cash. How much is the cash? That's 340. Cash is 340. If I sum all this together, what will it give me?
3,290.
So what's my total assets?
13,716.4.
So equity and liabilities. Equity. I have ordinary share capital. What's the ordinary share capital of the parents?
4,000.
4,000. I will get my consolidated retained earnings from working 6, which is how much? 3,582. Then after retained earnings, then there was loan stock, but we need to put in NCI. NCI at 1754.4. So what's the addition of all this?
9,336.4.
336. 336.
336.
9,336.
Okay, thank you. Then we have non-current liabilities. I could see a 10% loan stock. How much was it?
1,000 plus 200.
Okay, that's 1,002. I have current liabilities. There's a trade payables. How much is the trade payable?
2,016 naira.
2,016 naira. . And there's a bank overdraft.
1,120.
What's the addition of the two?
3,118.
Okay. What's my total equity and liabilities?
18,716.4.
Okay. So this actually touched on a lot of things that we should know
Sir, please go back.
from unrealized profits to impairment of goodwill to impairment of associates to fair value adjustments. It's a complete question. Okay. Do you have any question, please?
Yes, please, sir.
Okay.
Okay, sir. Thank you. Please, I want you to help me to just explain the logic behind this additional information line number E. The goodwill in ESCO is impaired and should be fully written off. And then an impairment loss of 184 is to be recognized on the investment in JCO. Actually, when I was going through this one, that 184, I deducted it from ESCO. That's when I was doing the consolidated retained earning. I put it under JCO, sorry, JCO. But now you said it's supposed to be under PICO. So I want you to just explain the logic because in when I was doing the investment in associates, I deducted it from I deducted it from ESCO. Yes, from this name said from the JCO. So now when you are now doing the consolidated retained earning, you move it to PICO. You know, I asked you that question. You say it's supposed to be when I did it, I put it under JCO. You said no, it's supposed to be under PICO. I can't ask you because we were chatting that time. I can't ask you the reason why. So, but now you put it there. I want you to just explain for me why we put it there because the question boldly said is, it should be recognized on the investment in JCO. Thank you, sir.
Good question, Femi. So the investment in question is an investment the parents made in JCO. So he invested 1 million naira in JCO. They now say that this 1 million naira we invested, it has been impaired by 184,000. So, and that was why they said an impairment loss of 184 is to be recognized on the investments in JCO. So, and you see that this investment was recognized in the books of PICO, is our investment. So who has that loss? Is it you that has that loss or is it the investee? It's you that lost now. You made an investment and you lost 184. So it's your loss. You remove it from your profits fully. And that is why it was deducted from the retained earnings of the investor, PICO. It's his loss. It's his investment. And the one I put before under JICO was an oversight. It was just a mistake. So because the double entry is you are debiting your investment and crediting your P&L. Sorry. You're crediting your investment and debiting your P&L. I hope that's clear.
Yeah, yes. I almost got that thing wrong also. I think the area is where to understand that it is not a subsidiary, that it is an associate. Because if it had been a subsidiary, we have done it in that way.
Exactly. That's absolutely correct. So if it had been an investment in subsidiary now, let's say if it was a goodwill that we lost, because that one will now be shared. That one will now be a loss between the parent and NCI. It will be a loss of all the investors. So in order for the loss to touch all of them, that was why we would recognize it. That was why we recognize it in the books of the subsidiary, because eventually we are still going to share the profit of the subsidiary among the investors. So you're correct.
So, sir, is it that any loss that the associates suffer, is the parent that will recognize it?
Not any loss. Any loss on investments in the
Sorry, loss of
associate. Yeah. Is
I
the
also,
investor suffer it?
I also want to say something. This is a professional exam and it's possible for anybody to have made a mistake. Let's assume you are solving this thing, then you made a mistake, you've gone to solve other question. Just like we detected now. You now realize that, oh, there's a figure you are not, you're supposed to have, adjusted and you forgot. What's the best way to treat this kind of situation? Or it's better you just leave it.
You leave it though. You leave it. Don't go back to it at all. Until probably maybe you have finished other ones. Because if I had gone ahead, with the way I did it before, let's say I don't know, there was somebody that reminded us, or maybe I was not that remembered myself. So let's say I did not remember. I left this 184 here. That I left it here. So the best that can happen is this. I'm not going to get a tick for this. The examiner is not going to give me a tick for this. And also, and that's the only thing. That because they don't mark final answer. Nobody marks your end result. Nobody cares about. So I'm going to lose like half or even less than half. I won't even lose a mark. So maybe this share of JCO and this one, I'm not going to lose marks here because my methodology is right. Even though the underlying figure I used is wrong, but my methodology is, I know what I'm doing. So the only place I will lose a mark is just this one. That is all. I might get, in fact, the guy can give me everything correct if every other thing is fine. So imagine you now go and start canceling. Cancel this one, you cancel that one, you cancel this one, you cancel that one. You are now disorganized because of a quarter of a mark. Don't go back. You forget, you forget, you move on and finish everything. It's not little mistakes that make people fail. Is I mean, it depends on the type of error, not small errors like this, anyways. Like they are really common in reporting. This will not make you fail reporting exam. Never, ever.
Thank you.
Yeah. Now, let me show you statement of profit or loss. So we have spent a lot of our time on statement of financial position. You need to understand that statement of profit or loss also exists in the sense that if you invest in a subsidiary, when you have an investment in subsidiary, you would need to, in addition to you will prepare consolidated financial statements. You also consolidate a statement of profit or loss. So the same way you have consolidated the financial position is the same way you are going to consolidate the P&L. So you are going to add all of these figures together. You add everything together. So, and also I'll use the opportunity to show you how to consolidate statement of changes in equity as well. So let's look at this question first. If you look at this question, they say PICO acquires 75% of the ordinary shares of ESCO on its incorporation on 2015. And after that, the summarized statement of profit or loss And the movement on retained earnings of the two companies as of December 2017 is given. So they give us all this. We are now required to prepare consolidated statement of profit or loss and extract from the statement of changes in equity, showing retained earnings and NCI. So this one now, if you want to prepare the consolidated statement of profit or loss, okay, we'll do consolidated statement of profit or loss for the year ended 31st December, I think 2017, is it? Yeah. So all we need to do is just to add the two figures together. For the sales, can you help me add these two together? What's that? 7.5 plus 19,000?
56,500.
56,500.
56,500. Then we have cost of sales. What's the addition of these ones?
25,000.
25,000. Then we'll have our gross profits.
31,500.
31,500. Then we have our administrative expenses. What's the addition of this?
11,000.
Then we have our profit before tax.
$20,500.
20,500. Then we have our income tax expense. How much is that? 6,000. 6,000. And what's our profit for the year?
500. 14,500.
Okay, 14,500. Now, these are group profit for the year. We need to share it between the parent and the associates. Sorry, and the non-controlling interest. So we'll then say profit attributable to. This is the parent. We call them owners of parents. And this is the NCI. We call them non-controlling interests. Okay, so you have to always do this because this is the consolidated profit. It needs to be shared on the consolidated statement. For the NCI, since we're told that the parent is 75%, it means the NCI has 25%. If you go and do 25% of 14.5, you are wrong. Do you know why you are wrong? Because this 14.5 also includes the profit of the parent. NCI cannot share profit of the parent. Can only share profit of the subsidiary. And profit of the subsidiary is simply 4,000 from the question. So what we can get is 25% of 4,000. And that means we're going to be looking at 1,000.
1,000.
1,000.
That means the parents will get a balance of 13.5. So this is usually the balancing figure. So that's how you share the underlying profit. So 14,500. Also, we are supposed to do, I think this pico, let me write the name. We're also supposed to do consolidated statement of changes in equity. For the year ended 31st December 2017. So they want us to prepare statement of changes in equity. They want us to show just retained earnings and NCI. So this would show retained earnings and non-controlling interests. So probably we'll have the total. So the balance brought forward. The balance brought forward for consolidated would be the balance brought forward of the parents and our share in the subsidiary, because it's consolidated we are preparing. So let me show you the workings. The workings for consolidated retained earnings brought forward. It should be that of PICO, which is 43,500, and our share of ESCO, which is 75% times 85. And what does that give us?
6,375.
So what's the addition of the two?
49,875.
That means
75. 5.
okay. That means it's non-controlling interest that will have the remaining. So the brought forward to non-controlling interest will be the remaining 25% of the subsidiary. And how much is that?
1,125.
So from that workings up there, this guy had 49,875. And this NCI has 2,125. And what's the total?
52,000.
52,000. 52.
Okay. And what's my profit for the year? So the parent 13,500, NCI 1,000, 13,500. There was no dividend paid. If there was, we'll have deducted that. So balance carried forward. What's the addition of these two?
63375. 63,375.
63,375. And this one, 3,125. And this one,
66,500.
66,500. And that's the end of this particular one. So there's really nothing new in terms of addition. All these, I just added them together. The only new thing here is the fact that when you derive the profits, you need to then share that profit between the owners of parent and NCI. And you see that the approach I used was to get the NCI portion first, and I was careful not to mistakenly go and do 25% of the group profits. That would be wrong. I only took for 25% of the profit of the subsidiary. You have to be very careful with this. Then, hence, owners of parent becomes the balancing figure. And then when I was doing my equity, the opening is that of the parent and our share in the subsidiary. This NCI took his own share in the subsidiary, and this profit was the profit determined from the consolidated P&L. And that was that. Now let's look at the second one that has to do with intragroup transactions. This says that PICO acquired 75% of the ordinary shares of ESCO on its incorporation in 2015. We're now told that ESCO sold goods to PICO at 2,500 during 2017, which cost ESCO 1,500 to purchase from an outside supplier. And I said one half, which is half, which is what they mean by half of the goods remained in PICO's inventory at the end of the year. We're now told that the summarized statement of profit or loss and movements in retained earnings of the two companies for the year ended 31 December 2017 are set out below. So they gave us the P&L of the two companies. We're now required to prepare consolidated profit or loss. So for this, there is an intragroup sales. So yeah, ESCO sold goods to PICO at 2,500. So these intragroup sales, like you know already, cannot be consolidated. It should be eliminated. So this 2,500, so ESCO sold to PICO. That means ESCO will have recognized this 2,500 in a sales. It will be sitting down as part of his revenue. While PICO will have recognized this 2,500 as part of his purchases. It will be sitting in his cost of sales. It has to be eliminated. So my workings one first is that the intragroup sales between ESCO and PICO should be eliminated. The sales, the 2,500 would have been recognized, in the sales of ESCO and the purchases of PICO. This should be eliminated. So we need to deduct and remove them. Additionally, these goods that ESCO sold for 2,500, he actually bought it for 1,400. He bought it for 1,400. That means that ESCO has made a profit of 1,400. This profit also needs to be eliminated to the extent of the goods that remain in inventory anyway. So he has made a profit of 2,500 minus 1,500, which is 1,000. But only half of these goods remain in inventory. So the profit we are going to eliminate is to the extent of the goods that remain in inventory. Therefore, we'll say additionally, ESCO made a profit of 1,000, which is 2,500 minus 1,500 from the transaction transaction with Pico. And this profit should be eliminated to the extent of the goods that remain in inventory. So the goods that remain in inventory is only half. So the unrealized profit here is therefore 1/2 times 1,000, which is 500. Now, these unrealized profits should be removed from the guy that made the profits. And who made the profits? ESCO. So we're going to remove it from the profit of ESCO. And in order to do that, since profit is usually a derived figure, so we'll put it inside its variable. So this is done by adding the unrealized profits to cost of sales. So when you add the unrealized profit to cost of sales, you are automatically reducing the profits. You are automatically reducing the gross profit by that same amount. So the intention is that this guy has made a profit and this profit has trickled his gross profits. We want to remove these unrealized profits from the gross profit of ESCO. Gross profit is a derived figure. You do sales minus cost of sales. So we cannot possibly find a way to remove it from P&L. So the only variable that makes sense for us to do that is cost of sales. Ordinarily, if you want to look at it plainly, where the profit is sitting is inside sales, because that was when he included that profit inside. But we cannot tamper with profits. Sorry, we cannot tamper with sales because of IFRS 15. IFRS 15 is very strict around sales. You don't joke around with what we record as sales. And if you remember, we also applied the same principle when we did manufacturer or dealer lessor, when we were trying to adjust for that PV of unguaranteed residual value. We could not add it to sales, but what we eventually did was to go and remove it from cost of sales. Now here is why unrealized profits are added to cost of sales, just because we cannot go and say you want to touch or remove it from your sales. No, it's not worked. It's not worked in that manner. And this 500 would be added to our cost of sales. And these are the major adjustments here. And let's consolidate. So we are considering Pico. We want to prepare our consolidated statement of profit or loss for the year ended 31st December 2024. Okay. All our sales. Can you add these two together? 37,500 plus 19,000.
56,500.
56,500. What's this now? 56,500 minus the unrealized profit of how much? 25. How much is that?
54,000.
I thought unrealized profits was 500.
Okay. I mean the intragroup sales of 25 from workings one. We say we should eliminate the intragroup sales, not unrealized profit. Then our cost of sales, what's the addition of these two? This 25,000. So I have 25,000. I'll remove the intragroup sales, then add unrealized profits. What does that give me?
23,000.
3,000.
So what's my gross profit?
31,000.
That's 31,000. The next item is my administrative expenses. What's the addition of the two?
11,000.
11,000. Then what's my profit before tax?
20,000.
What is my income tax? 6,000. Then my profit for the year,
13,000.
18,000. Then I'll do profits attributable to owners of parents and non-controlling interests. We have 75%.
Now 25%.
They have 25%. And you don't go and do a 14,000. That's wrong. To be of how much?
4,000.
But again,
That's 1,000.
yes, but again, this 4,000, there are some adjustment that has gone through it, and which is the unrealized profits. This 4,000, we have adjusted unrealized profit there. We have, so that means the parents and the NCI will lose that portion of that profit as a result of consolidation. So, and what was the unrealized profit?
500.
So, what's 25% of 35?
87.5.
875.
875.
875.
Okay. Now, owners of parents would get the balancing figure. And what's the balancing figure?
13,125.
The total?
Hello, sir.
Yes.
Sorry, why did we minus the 500 from the non-controlling interest there?
Yes. This 4,000 profits. So if you just apply 25% of 4,000, there is a 500 unrealized profit that has been eliminated. That has been eliminated from, ESCO made a profit that we eliminated a 500 as unrealized. So we need to remove it because it's not there anymore. If you don't remove it, that means you want to be sharing profit that does not exist as far as the group level is concerned. NCI, in this subsidiaries profit, there was an unrealized profit of 500 that has been eliminated, which is not adjusted here already. So we need to remove it. And that was why we removed this 500. Forma, did I answer your question?
Yes, sir. Yes, sir. Thank you.
Yeah. So another question is that saying that why are we not applying 25% directly on this 14,000? If you do that, that will also be wrong because that means you are now giving NCI a share of the parent's profits. This 14,000 comprises that of the parent and the subsidiary. NCI only has access to the share of subsidiaries' profit. If you look at all we have been doing, the profit of whom we share is that of the subsidiary. We share it between the parent and the NCI. So that's why we did not apply this 25% on this 14,000. We only apply it on the subsidiaries' profit after making adjustment for all the unrealized profit and the rest. And that's the end of this question.
Sir, please, I have a
Sir,
question.
Okay, please ask Shine.
Okay, so sir, where I have a little confusion is when you were explaining that about the unrealized profit, that it's going to be 500 being what is remaining. I was thinking that the intergroup trading we are supposed to deduct as well. Because if they collected, my own reasoning, if they had collected good worth 2005 and they've sold half of it and the remaining half, why are we still canceling it from both parents and the subsidiary? I was thinking it is what is left we should have cancelled, sir.
Oh, beautiful. Beautiful reasoning. I like that. So she's saying that since they sold 2005 goods to one another, and we have sold a portion of the goods out, that why are we still canceling 25? That why are we not canceling half, which is 1,250? Okay, so fantastic idea. Now, you see, what was recorded in their books as revenue is 2005. What was recorded in Pico's as purchases was 2005. And any intragroup transactions, the gross amount of those intragroup transactions should be eliminated. So even if it is receivables and payables, the gross amounts eliminated. In as much as that amount is still in their books at that stated amount. Revenue is revenue. So whether you have sold some of it out, your revenue, what is stated in their revenue is 25. What is stated in the purchases of the other of the buying entity is 25. You eliminate it fully. Always, you're asking a very logical question, but is the way it's reported. So what they are reporting is what we eliminate. Now, where what is remaining in the inventory comes in is at the level of inventory. So in their inventory now, what is left there? What is left there is just the unsold goods, which is just half the unsold. That's at the inventory level, and which we have already learned in statement of financial position that all the unrealized profits in that inventory in the books of whoever is holding it, in this case, who is the parent, the unrealized profit should be eliminated. And since only half of these goods remain in inventory, that means only half of the profit determined would be in that inventory. which is that 500. So the unrealized profits that is still on hand, the profit that is still on hand, which is the unrealized profit, is just 500. And the double entry for that is the first leg. We'll remove it from inventory in the statement of financial position. The second leg goes to P&L, and that is the one we usually remove from retained earnings, which is actually coming from here. This is where it's coming from. The adjustment we have made here is actually to the P&L of the guy holding the inventory in his books, which is Pico. So it is at that level. But the revenue and the purchases should be eliminated fully because it's an intra-group revenue. It's an intra-group purchases. Remove it, whether it is the good has been totally sold out or not. But that revenue and purchases is still in your books. We don't want to have anything to do with that. We don't believe that that's sales. It's the same thing. We sold. It's just like maybe we did not sell to anybody. I only sold to you as my subsidiary. 2.5. Let's say he only has 2.5 in his sales. The other guy only has 2.5 in his purchases. And that was all we sold. We now made a profit. As far as the group is concerned, you have not made any profit. It's just between yourself. It's transactions between two guys. So to consolidate, remove that 2.5 first from your revenue and from your purchases. Remove it. Whether you have sold it outside or it's there as 2.5 in your book, is there as 2.5 in the other guy's purchases. That is eliminated. So it doesn't affect what is in inventory. That one is at the level of inventory and statement of financial position, which we will also eliminate with unrealized profit. So I hope that is clear.
If all the goods are being sold to outsiders, there won't be need for unrealized profit.
Exactly, yes. There won't be linked for unrealized profit. Okay, we need to solve one more, then I will give you this as assignments, which I would solve before I move to ratio analysis. Before I move to ratio analysis. So let's just solve this one. It says Pico acquires 75% of the 50,000 ordinary shares of ESCO on 1st April 2017. The summarized statement of profit or loss for the year ended 31st December 2017 are set out below. So I have all these items here. In this required, prepare the consolidated statement of profit or loss and extract of the statement of changes in equity to include the retained earnings and non-controlling interests. Okay, let's quickly solve this. So what's happening here? Really nothing, really. So except the fact that we acquired this subsidiary on April 2017 and the year end is December. So that means we acquired him during the year. So let's see how that would impact. So we're talking about PICO, consolidated statement of profit or loss for the year ended 31st December 2017. So my sales. So what will be the sales that we are going to consolidate? How much?
125,000.
I would say
Okay,
it's 85,000 plus 9/12 times 40,000 naira.
that's fantastic. That's absolutely correct. That's absolutely correct. So that's 85,000 plus 9/12 times
40,000.
and the reason is 9/12 is that we acquired this subsidiary during the year. And since this is P&L, that means we can only share revenue of the subsidiary for 9 months. This is different from statement of financial position that even if you acquire him during the year, you will still consolidate fully because it's a position statement. But this one, you prorate. You have to remember to prorate. And you find in your questions that they will give you something like this, where you'll be required to do all these prorations. So what will this then give you?
$115,000.
115,000. Okay. What's my cost of sales? That's 32.5 plus 9 over 12 of 18,000. 32.5 plus. How much is that?
46,000.
What's my gross profit?
69,000.
69,000.
Now, my other income, there was a dividend received from ESCO. This will be cancelled out. This will be what? Be cancelled out. It's a similar transaction. You don't consolidate this. So that takes me to admin expense. 21.5 plus 6,000. So how much is this?
26,000.
26,000. Then my profit before tax. So what's the profit before tax?
43,000.
43,000.
43,000. And what's my income tax? 11.5 plus 4,000. 11.5 plus 9 over 12 times 4,000. How much is that?
14,500. 14,500.
So what's my profit for the year?
28,500.
So I will have my profits attributable to owners of parents and non-controlling interests. Since I have 75%, that means NCI will have 25%. And what's the profit of NCI? 12,000. So NCI will take 12,000, but times 9 over 12. How much is that?
2,250.
Then parent will have the balance. What's that?
26,250. 26,250.
Okay. That means the total is 28,500. That's it for that question. And we're also asked to prepare consolidated retained earnings, showing retained earnings and NCI. So PICO, consolidated statement of changes in equity, showing retained earnings and the non-controlling interests. Yeah. Yeah. So what's my balance go forward for my retained earnings? That would be retained earnings go forward of the parent plus our share in the retained earnings of the subsidiary. But this subsidiary, this retained earnings go forward is representing retained earnings of 1st of January 2017. And as at that date, we haven't acquired the subsidiary. That means this 20,500 is a pre-acquisition retained earnings, which is usually cancelled out. So we cannot consolidate that. So the consolidated retained earnings will only be this 40,500. So this is 40,500. That means this guy will gain nothing in this case. 40,500. However, for the NCI, we can actually get value of NCI in this case because this question actually gave me share capital and it also gave me pre-acquisition retained earnings. Where is it? This is the retained earnings as at January 2017. Not only that, the profit, this profit between January and ending of March before I acquired it would also be pre. This will also be pre as well, so I would also include this. Yes. Yes, I'm coming. Benny, mon from case study. Yes. So value of NCI, value of NCI would have how much? We'll have share capital. How much is the share capital? 50,000. Then pre-acquisition retained earnings, which is 20,500 plus 20,500, which is this retained earnings at the beginning, plus 3/12 of this, because this profit, 3/12 of it was before we acquired the subsidiary. So plus 3/12 times 12,000. And how much is that?
23,500.
23,500. And what's the total? 73.
73,500.
So NCI is 25% times 73,500. And how much is that?
18,375.
18,375. 18,375. 18,375. So having determined that, I can then get my profit for the year. And what's the profit for the year? For the parent is 26,250. And this one, 2,250. What's the total? 28,500. Then dividend paid We paid a dividend of 6,000 here. You remove dividend paid. And also, the subsidiary also paid dividend, but the one that was paid to the parent, which is 75% of this 3,000, has been cancelled out. Let me do 25% of this. That should be 750, but just confirm.
Correct, sir. 750.
750. So this 750. So what's the addition of the two? 6,750. So what's the balance carry forward? Can you sum this for me?
6750 retains earnings column.
Okay. What about this?
19,875.
How about this?
Eighty-six to 50 to 86 to 5.
8 to 5. Okay, that's the end of this question. So you can practice this question 4, see if you are able to solve it. I know that I'm supposed to have skills guys in the evening today, and I know that you guys, SBR also, you're not doing anything in the evening today. So we might have the class where we would solve this as to correct whatever it is you have done, and probably maybe one additional past question to round up on group account for FR and SBR. We should round up group account for you guys also next week. Should round up about next week with you as well. So I'll see you guys later. Have a wonderful remaining part of your
Sir,
day.
hello, sir. Hello, sir.
Yeah, Michael.
Sir, please, can you share this video today? Is it possible, sir?
Mm, I'm going to class now. I'm going to solo. So I'll share it today, but much later in the evening.
Okay,
Okay,
no
so what
problem,
about
sir.
the
Thank you.
material? Can we have the material now?
Like
So
Oh,
we
before
yes.
the
can revise.
class. Before the class
Oh,
in the
yes,
evening.
yes. You're going to get the material now.
Then, sir, are you asking us to join the class tonight? Will it be online also?
Yes, yes, to be online.
Okay, what time? Or it will be shared, Abby?
Yeah, it will be shared. It will be between 7 and 8.
Okay, sir. Thank you, sir.
All right, I'll let you know. Bye.